Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding solvency ratios, a key to financial health. Ever wondered how businesses measure their ability to keep their financial commitments? Solvency ratios are the key. These financial metrics help assess if a company can meet its long-term debts and obligations. Understanding solvency ratios gives investors and stakeholders an insight into a company's financial health beyond just profits. This knowledge helps in making informed decisions, especially in uncertain economic times. You'll discover not only how these ratios work but also why they matter for anyone with a stake in a company's future. Dive in to see how solvency ratios can offer a clearer view of financial stability and confidence. What are solvency ratios? Solvency ratios are the unsung heroes of financial analysis. They help you understand if a company can meet its long-term obligations and stay afloat in rocky waters. Think of them like a financial weather forecast, showing whether the business can withstand economic storms or thrive in sunny conditions. Curious how they work? Let's dive in. Understanding solvency ratios. At their core, solvency ratios measure a company's ability to meet its long-term debts. They help investors and stakeholders figure out if a business is solid or shaky. These ratios are like a checkup at the doctor's office, ensuring everything is running smoothly and there's no hidden trouble. There are a few key types of solvency ratios. Each offers a unique peek into a company's financial health. Here's a quick overview. Debt-to-equity ratio. This ratio compares a company's total liabilities with its shareholder equity. It's like comparing apples and oranges to see how balanced the company's finances are. A high ratio might mean the company is riding the debt wave, while a low one could suggest it's relying more on its own resources. Interest coverage ratio. This measures how easily a company can pay interest on its outstanding debt, based on its earnings. Imagine you've got a set of bills to pay every month. The interest coverage ratio determines if the company's paycheck stretches far enough to cover those bills. Importance of solvency ratios. Why should you care about solvency ratios? Because they are crucial for assessing financial stability. These ratios give insight into whether a company is built on a sturdy foundation or a house of cards. For investors, they are like the lifeboats on a ship, providing assurance in case of financial trouble. Here are 3 reasons why solvency ratios matter. Long-term viability. Solvency ratios reveal if a company can survive in the long haul. They show if the business has enough legroom to pay off debts without winding up in a financial pickle. Investor confidence. Strong solvency ratios can attract investors, providing them with confidence that their investment won't sink. It's like a badge of trust, signaling that the company is financially sound. Strategic decisions. Companies rely on these ratios to make informed decisions. Whether it's expanding operations or entering new markets, solvency ratios help ensure these moves are financially prudent. With these points in mind, solvency ratios are indispensable tools in the financial toolbox. They're like the compass keeping businesses on the right path through the stormy seas of the financial world. Types of solvency ratios. Solvency ratios are essential tools for understanding a company's long-term health. They reveal if a company can meet its long-term obligations or if it's sinking under the weight of too much debt. Let's take a closer look at some key types of solvency ratios and what they tell us. Debt-to-equity ratio. The debt-to-equity ratio is a crucial measure that compares a company's total debt to its shareholder equity. The formula is simple. Text, debt-to-equity ratio, equals, text, total debt, text, shareholder equity. Why is this ratio important? It reveals how a company finances its operations, through debt, borrowed money, or equity, money from shareholders. A high ratio might suggest the company is heavily financed by debt, which can be risky if earnings are unstable. On the other hand, a low ratio might indicate a conservative approach, using equity more than debt. But beware, both extremes have their own risks, and finding the right balance is key. Debt ratio. The debt ratio provides a broader look at a company's financial obligations compared to its total assets. Calculated as text, debt ratio, equals, text, total debt, text, total assets. What does it tell you? A higher debt ratio implies more liability, meaning the company relies heavily on debt. This can be risky if market conditions change. Think of it as walking a tightrope. A lower ratio indicates less debt reliance, signaling a potentially safer financial posture. It's all about understanding how deep the company is in debt waters. Equity ratio. The equity ratio shows the proportion of a company's assets financed by shareholders' equity. It's calculated using text, equity ratio, equals, frac, text, shareholder equity, text, total assets. Why should you care? This ratio highlights a company's reliance on equity rather than debt to fund its assets. A higher equity ratio suggests less risk and a strong buffer against losses, akin to having a safety net under that tightrope. Conversely, a lower ratio might indicate a heavier reliance on borrowed money. It's a peek into how stable a company might be during tough times. Interest coverage ratio. The interest coverage ratio measures a company's ability to pay interest on its debt with its earnings. Here's how you figure it out. Text, interest coverage ratio, equals, frac, text, earnings before interest and taxes, EBIT, text, interest expense. This ratio is fundamental. It shows if a company can comfortably cover its interest payments or if it's on the verge of drowning in debt interest. A higher ratio means the company easily meets its interest payments, akin to having a robust umbrella in a financial storm. A lower ratio raises flags, hinting at potential struggles in covering financial obligations. Cash flow to debt ratio. The cash flow to debt ratio assesses a company's cash flow relative to its total debt. Calculated by text, cash flow to debt ratio, equals, frac, text, operating cash flow, text, total debt. Why is this ratio significant? It indicates how efficiently a company uses its cash flow to meet its debt obligations. If the ratio is high, it means the company generates ample cash flow to cover its debt, similar to having a full tank for a long journey. A low ratio suggests potential challenges in maintaining debt payments, signaling caution. These solvency ratios are incredible tools to assess a company's financial landscape. Each provides a slice of insight, painting a picture of financial stability or risk. So next time you're eyeing a company's financials, these ratios are your go-to compass. Importance of solvency ratios. Solvency ratios are like a financial flashlight that helps you peer into the depths of a company's long-term financial health. Whether you're an investor, a creditor, or part of the management team, understanding these ratios is crucial. They are the tools you need to decide if a company is a safe bet or a risky venture. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.